Have you ever wondered what the people around you make? Your neighbor, your friend down the street, the person that you know from work living in the town next door? Well, the fact is, a lot of people don't know because people tend to hang out with people just like themselves, and those same people have similar incomes, usually. In this video, we're going to break it down for you from the most modest income all the way up to the wealthiest Americans and everywhere in between. All right, let's not waste any time. Let's get right into it. Level 1 is the most modest, and that's where Social Security is their entire income. That's roughly 27% of retirement households. At this level, Social Security isn't part of the foundation. It is the only part of the foundation. In January of 2026, the average American received $2,071 per month in Social Security. That's about $25,000 per year. For married couples where both partners receive benefits, the average payment is $3,208 a month or $38,500 per year. About 1 in 4 American households live at this level. That's 27% per census data, 2024 census data. But the defining trait of level 1 isn't the actual dollar amount. It's that every dollar that comes in is already accounted for before it's ever spent. The standard Medicare Part B premium for 2026 is $202.90, and that comes out of the Social Security check if they're receiving Medicare before they even receive that check. What remains goes to housing, food, utilities, and prescriptions, usually in that order. And money does not sit in the account very long. Groceries usually get purchased the week that the check comes in, as do prescriptions, and by the end of week 4, the couple or the household is living on fumes. And it's really important to note that there are no shock absorbers at this level. A $900 car repair isn't just something that they have to pay for. It's a major event. Sometimes they need to spread it out over 3 months if they can pay for it at all. Dental work and hearing aids, what original Medicare doesn't cover, sometimes gets put off for years. So do home repairs. The grab bar that should have been put in the shower 10 years ago, the wobbly step that people step on, which could cause them to fall. They wait for either a helpful son-in-law or a tax return in many cases. Many retirees add part-time work, which is often a smart move, but they do need to be aware of Social Security's earnings limits, $24,480 per year in 2026. Anything above that, the recipient needs to give back $1 for every $2 over that amount to Social Security. Once they reach full retirement age, they get it back in the form of a higher payment. One more thing about level 1, and this matters a lot. There are safety nets built into our system to help people at level 1. Medicare savings programs that pay the Part B premium, extra help for prescription costs, and the Supplemental Nutrition Assistance Program known as SNAP. These aren't handouts. You paid into the system for decades. Using these programs is collecting on a claim, not asking for charity. Finally, the difference between a good month and a bad month sometimes comes down to $200 or $300 at level 1. There's nothing that's so tight in the rest of this video as it is in level 1. Next up is level 2. Level 2 looks like level 1, but with a cushion. So it's Social Security plus a cushion. It's usually an IRA or a 401k with $50,000, $100,000, $150,000 in it. Sometimes there's part-time income on top of that. Household income is somewhere between $30,000 and $50,000 a year at level 2. What percentage of retirement age households live at level 2? Roughly 18% or 1 in 6 households. Here's what separates level 2 from levels 3, 4, 5, and 6 above. Withdrawals from the IRA or 401k aren't planned. They're usually reactions. The furnace fails, so $4,000 comes out of the IRA. There's a medical bill, and it requires an additional $3,000. The retirement account functions as an emergency fund with a tax bill attached because everything you take out is considered ordinary income. For context, the median income for households at age 65 and older was $56,680 in 2024, according to the Census Bureau. Most level 2 households sit below that line. They're keeping up with essentials, but every extra is negotiated. The reactive pattern creates level 2's biggest risk. If someone needs a roof repair and the market drops, most of the time they're going to take the money to repair the roof if they have it available to them, but they're going to be selling shares at a lower price. And those shares are gone when the market recovers. Done a few times early in retirement, and the portfolio that would have lasted a lifetime doesn't. The lifestyle here is careful and stable. One modest trip a year, often to see family. Store brands in the cart. There's pride at this level, and there should be. These households make $40,000 do the work of $60,000. On healthcare, a lot of people at this level choose a Medicare Advantage plan with a zero premium, and they find out later that that zero premium wasn't the bargain that it looked to be when things go wrong. A Medigap plan costs more initially, but it smooths out the surprises. Medicare Advantage plans have copays. Neither Medicare Advantage nor Medigap are wrong, by the way, but the point is to understand that this is a choice. You're making a choice now for potential future costs later. And here's the single move that has the biggest leverage at level 2, the Social Security claiming decision. People who claim at age 62 get 70% of what they would have received at age 67, and if they claim at age 70, they get 124% of what they would have received at age 67. For households where Social Security carries most of the load, this is a very important decision and one that should be given a lot of thought before someone claims. Level number 3, all expenses are covered by guaranteed income. Now, what do I mean by guaranteed income? Let me explain. Social Security plus a pension, or Social Security plus an annuity, pays the day-to-day bills. The portfolio pays for the extras. Planners today call this an income floor. A generation ago, the company pension built it automatically. Today, most private workers don't have a pension, they have a 401k, and they need to assemble a floor deliberately. This is also why someone can retire with $1 million and have no floor to cover their day-to-day bills. Household income at this level sits somewhere between $50,000 and $75,000, and the median income in this country sits right in the middle, $56,680. This is the center of American retirement, and 1 in 6 are at this level, approximately 16%. Picture this: a retired teacher and a retired firefighter married with $350,000 saved. Their two pensions plus Social Security bring in $68,000 per year, guaranteed. Every essential covered before the portfolio contributes a dime. Now picture a couple with $1.2 million in their IRA. On paper, they're 3 times wealthier, but every month they decide how much to withdraw, in what market, from which account. When stocks fall, their confidence falls with it. By income structure, the teacher and the firefighter sit above the millionaires. That's the test of level 3. Not your net worth, but your income level, which shows up in your account on the first of every month, no matter what the market conditions. And then there's the mental game at this level. In the Alliance for Lifetime Income's 2024 study, 46% of people aged 45 to 75 said spending their savings gives them anxiety. Guaranteed income removes that decision from the month. The floor is the thing that lets you stop checking your portfolio every morning. Want to know what your own floor is? It's actually really simple. Add up Social Security and any pension or annuity payments. Then add up the 12 bills you'd still pay if you canceled everything fun. If the first covers the second, you're at level 3 or higher, no matter what your account statements say. If your guaranteed income doesn't cover your essentials yet, the gap is easier to close than most people think. Delaying Social Security, a small income annuity, or removing one fixed expense can close the gap. Gang, if you're still doing your finances using spreadsheets, you're doing it the old-fashioned way. Spreadsheets are prone to errors, they don't connect to each other very well, and finding a mistake is a hassle. If a number is off in one cell, sometimes it means the entire spreadsheet is wrong. On this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. This is the financial planning software that I personally use. Bolden will let you create what-if scenarios, can help you see what's ahead, and will help you track your progress across 6 key areas. If you'd like to try Bolden for free, you can use our affiliate link. Go to go.bolden.com/Schmidt, and you can get 2 weeks free of their full featured software. If you decide to keep it after that, it's just $12 a month paid annually. Level 4 is when you have 3 or more income streams happening at the same time, and it feels a lot like when you were working. Income at this level typically runs between $75,000 and $120,000 a year, and income comes from at least 3 different streams: Social Security, a pension or annuity, and planned portfolio withdrawals. About 17% of retirement households reach level 4, again about 1 in 6. Now notice I used the word planned when I talked about portfolio withdrawals. At level 4, taking money from your retirement accounts is planned. They follow a system, a percentage each year, or a fixed dollar amount reviewed annually, or a guardrails approach that adjusts with markets. The money shows up on schedule because that's what it was designed to do. A couple drawing $3,200 per month in combined Social Security, $2,400 from a pension, and $1,800 in monthly portfolio withdrawals brings in $88,800 per year. 3 streams with 3 different jobs. The first 2 cover essentials, and the third funds lifestyle. And here's why this structure matters so much, and frankly, there's real research behind it. David Blanchett and Michael Fink published a study called Guaranteed Income, a License to Spend. They found that retirees spent twice as much when it's guaranteed income when compared to the equivalent in an investment account. And that's the real luxury of level 4. It's not the granite countertops, it's permission. Permission to spend and feel okay about it. Level 4 retirees are typically the engineers, managers, nurses, and dual income couples who save steadily into a 401k for 30 plus years. Many worked with a financial planner or financial planning software to test what their future would look like. Next up, level 5, and here the problem flips to taxes. At this level, something strange happens. The question is no longer, do we have enough? The question now becomes, how do we not trigger extra costs by doing things the right way? Roughly 1 in 8 households, 13%, sit at level 5. 3 tripwires define this level. The first is IRMA. IRMA stands for Income-Related Monthly Adjustment Amount, and it's a surcharge on your Medicare Part B premium. If you're single and your income exceeds $109,000, then you will be in the first bracket, so your IRMA surcharge kicks in. If you're married, filing jointly, then the number doubles to $218,000. Exceed $218,000 and you'll be in the first surcharge bracket. There are 2 details that make IRMA tricky. The first is that it's based on your income from 2 years ago, which catches a lot of people off guard because oftentimes when people go into retirement, their income goes down, yet they owe a big Medicare surcharge because of income from 24 months ago. The second is that it's not progressive like taxes. If you go $1 over into the next tier, you pay the full premium of that next tier, even if you went over by $1. Also, at 73, for most of you anyway, you're going to be faced with the possibility of required minimum distributions. What are required minimum distributions? Well, the government wants its tax on the income that you deposited in your 401k or your IRA tax deferred. They want you to sell it and realize that tax. And so that's called a required minimum distribution, and it could push you up into a higher IRMA tier. And also, RMDs could push you up into a higher level of tax on Social Security. For a married couple filing jointly, as an example, income, often called combined income, above $32,000 makes up to 50% of Social Security benefits taxable. It's above $44,000, up to 85% could be taxable. Level 5 households are well past these thresholds. When you add it up, the order that you withdraw from your accounts changes the total tax paid over a 20-year retirement, sometimes by 6 figures. Taxable first, tax deferred second, Roth third. That's the standard playbook. But at this level, the standard playbook isn't always the optimal one. This is why level 5 retirees talk about Roth conversions at dinner parties. The window between retirement and age 73 before RMDs begin is often the lowest income stretch of their adult lives. Converting in those years moves money out of future RMDs at today's rates. Gang, how prepared are you for retirement really? Many people think that they're more prepared than they really are, but when they dig deeper, they find out that they missed something, or several somethings. That's why we created our absolutely free retirement readiness quiz. It's 15 questions, it takes 2 minutes, and you'll get a 12-page report sent to you absolutely free. No credit card, no phone number, nothing like that. Go to hollyschmidt.com/quiz to take the quiz. When you're done, the report will be sent to you instantly. You'll also be put on our list and get tips, tricks, and other useful information a few times a week. Level 6, $200,000 or more in income. This level, the principal generally stays put. People don't spend it down. Dividends, interest, rental income, and business distributions cover the entire lifestyle. Social Security still arrives, and frankly, at this level, the household's done so well, usually anyway, that it is at or near the maximum. Importantly, for people at this level, it's a line item. It's not the most important thing. And if Social Security were to go away tomorrow, their lifestyle wouldn't change dramatically. About 1 in 11 households, 9%, reach level 6. These are retired business owners, executives, physicians, and partners. Many still sit on boards or advise companies, which adds another stream and keeps them in circulation. The question isn't whether the money will last. A portfolio that's generating $200,000 a year or more in income lasts indefinitely. Here the work changes entirely. The planning is around everything but spending. Trusts that move assets to the next generation without a probate process. Qualified charitable distributions that satisfy RMDs while supporting causes tax-free. Annual gifting that moves money to children and grandchildren year after year. Structures that decide what happens to a business or rental portfolio when the founder is gone. And one word of caution, even level 6 has a weak spot, concentration risk. A retiree with $200,000 of rental income from 8 properties in one town has a much higher risk than a retiree who has $200,000 of income from 8 properties spread across 8 different towns. The income numbers match, but the durability does not. And here's the thread that ties every single one of these 6 levels together. The households at every level aren't the ones with the biggest number. They're the ones whose income was built deliberately. Net worth is a scoreboard number. Income is the game. If you like this video, check out that video, the 6 levels of wealth in retirement. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.